video, we are going to discuss derivative transactions that are designated as cash flow hedges. A cash flow hedge is a derivative contract that is used to hedge cash flow risk resulting from variability in cash flows. So, for example, an interest rate swap can be used to convert variable cash flows to a fixed cash flows and thus eliminating the variability. So again, that's the situation where we're in a variable rate loan, for example. We're worried that interest rates are going to go up and our interest expense is going to get too high. So we can enter into this interest rate swap, which will basically refinance, in a way, our variable rate loan to a fixed rate one. Before we get too far, though, we do need to talk about how these variable rates are set. So in the past, all of these variable rate instruments were set based on something called LIBOR, which is the London Interbank Offered Rate. And so LIBOR is an index. It's a interest rate that basically banks use to determine how much they would lend money to each other. So at the end of the day, banks do this really weird thing where sometimes some of them will have a bunch of extra cash sitting around and they will loan it to another bank overnight at some interest rate. And that's usually determined by this LIBOR, or this London Interbank Offered Rate. And so the banks kind of negotiate what this rate is, they get the deal done, and then they publish this information. And so then what we do is when we have variable rate products that are offered to the public, they tend to be written at LIBOR plus 2% or LIBOR plus 3%. Because anybody other than another bank is considered to be more risky, so they would have to charge a higher rate. So LIBOR was the basis of pretty much every variable rate instrument since like 1986, until it came out that there was a massive price fixing scandal in which basically it turned out there were kind of two banking bros sitting in a back room just like fixing this thing for their own mutual benefit. And so that really didn't sit well with a lot of people. And so as of June 30th, 2023, the LIBOR was retired and it's been replaced, at least here in the US, with the Secured Overnight Financing Rate, which is basically the same thing, but it's a US controlled index. Hopefully there are better controls around that process of setting that number, but I have not had a lot of chance to dig into it, and it hasn't been used for very long yet, so we'll see how that goes. For the purposes of our examples, I'm still going to use LIBOR because that was what was used when your book was written. And so in this example, we're going to say that we have issued a variable rate note that pays LIBOR. So we are paying interest based on LIBOR. And so in this example, it's a $10 million note and we're paying 5.8%, which gives us $580,000 of expense in year one. But what we're worried about is that the LIBOR rate is going to increase, and therefore the amount of cash that we have to pay out as interest expense is also going to increase. So in the best case scenario across the top, LIBOR goes down. And so we don't have to pay as much as we're paying this year. Let's say it goes down 0.8%. We'll only have to pay $500,000 in expense next year. Sweet. We saved $80,000 that we had been earmarked for interest expense, but now we can spend on something else. However, if we go down to the bottom of the screen where LIBOR goes up, this is where things start getting a little dicey. So let's say that LIBOR instead goes up by 0.8%. So that means that we're going to have an extra $80,000 that we're going to have to come up with in cash to pay for this note in year two that we maybe hadn't been planning on. If that trend continues, this could get worse and worse over time. We may reach a point where we don't have enough cash on hand to continue making our interest payments. So in order to hedge this risk, what we could do is enter into an interest rate swap in which we will pay 6% and we will receive LIBOR. So we enter into a transaction with another party where we each pay each other. So what the other party is basically going to do what we are doing in our note, and they're going to pay us LIBOR. And then we are going to pay them a fixed rate of, in this example, 6%. So let's say that LIBOR goes down, so we'll go across the top. that's actually bad for us because LIBOR could dip below our 6%, and we would actually be saving money if we had the LIBOR side. All of a sudden, that's $80,000 of expense that we are paying that we wouldn't have had to had we had the LIBOR side. However, remember what we're worried about is we're worried about LIBOR going up. So if we go back down to the bottom, if LIBOR does go back up, it doesn't matter how much it goes up. We are only going to pay our 6% or our $600,000 every year. So in this case, we're not paying as much as we could have because of this swap, right? So we are fixed. And we're just going to pay our same amount, and we're good with the $600,000. So we're not really worried about it. We know we can make that cash payment. All right, so let's put this together. What we get here is that our variable cash flows cancel each other out. And so essentially, we're receiving LIBOR, and then we're just turning around and passing it on to pay our note. And then we turn around and pay just fixed. So every year, we're going to pay $600,000 of interest expense, regardless of what LIBOR does. We have completely insulated us from the risk of LIBOR. So we're paying a little bit, $20,000 more than we had to in year one. And we lose any ability to pay less should LIBOR go down, but we've insulated ourselves from volatility. And so we have gotten rid of the problem that will come along if LIBOR goes up to a point where we cannot pay our interest anymore. All right, so let's take a minute to illustrate this. I'm going to need some help. Thanks, Chloe. I knew I could count on you. So let's say that Chloe has that note and she is paying LIBOR to Brooklyn. Chloe decides that she's worried about this risk and she would like to enter into an interest rate swap. So she calls up Anna. And Anna's like, sure, I'm not worried about LIBOR. I'll pay you LIBOR and you pay me fixed. So essentially what this does is it makes it so that Chloe can collect her LIBOR from Annabelle and just hand it straight over to Brooklyn. And so economically, Chloe is just paying fixed and Annabelle is paying Brooklyn LIBOR. Okay, so when we have a cash flow hedge, we're going to record a journal entry whenever a new derivative contract is purchased, whenever we reach a reporting date, because that's going to trigger a fair value adjustment, and whenever a contract is settled. However, here, the benefit of hedge accounting, remember, there is not, in some situations, they're not necessarily a hedged item on our balance sheet. So in this case, the benefit of hedge accounting is going to be that when we do that fair value adjustment to our derivative, the changes in the fair value are going to go through other comprehensive income instead of income. So basically what happens is that fair value adjustment is going to get shuffled off to equity and it's going to hang out over there until such time as we actually realize our gain or loss. Then it's going to come back over onto our income statement. So again, let's go ahead and take a look at our next example. In this example, we're going to go over a cash flow hedge. So we have Hart Golf Company using titanium in the production of its specialty drivers. Hart anticipates that it will need to purchase 200 ounces of titanium in November 2020 for clubs that will be sold in advance of the spring and summer of 2021. However, if the price of titanium increases, this will increase the cost to produce the clubs, which will result in lower profit margins. To hedge the risk of increased titanium prices, on May 1st of 2020, Hart enters into a titanium futures contract and designates this futures contract as a cash flow hedge in the anticipated titanium purchase. The notional amount of the contract is 200 ounces, and the term of the contract give Hart the right to purchase the titanium at a price of $500 per ounce. The price will be good until the contract expires on November 30th of 2020. Assume the following data with respect to the price of the futures contract and the titanium inventory purchase. So we have our little chart down here that has the notional price in ounces. So that's in our contract. Ignore this. Our spot price in ounces, that is also in, so that is whatever the current market price is. And then we have our strike price, which is the contracted value. So as of the start of our contract, in this case, we did not pay anything to get into the contract. So our cost here, or the value of our contract, is $0 because we have our notional amount times our spot price minus our strike price, and that gives us $0. However, you can see that, again, remember, we're worried about the price of titanium going up. And we already have future info, so we know that that is in fact what happens. And so the benefit of this contract is that we're able to buy at 500 when everyone else is able to buy in the market at 525. So as of September 20th, this other date they gave us, the value of our contract is going to be that 200 ounces times the difference between what the market is paying and what we're going to pay. So that's a value of $5,000. So now let's get down to our instructions here. They would like us to do a series of journal entries that are going to include the inception of the futures contract, assuming we paid no premium, the first financial statement preparation date, then a date when the company purchases the titanium and settles the futures contract, and then when the company finally sells those finished goods that have been made from the titanium. All right, so initially they enter into this futures contract and it costs them nothing. So that is $0 in our initial futures contract account, because remember, we're going to record that at cost and it cost us nothing. Then on our first financial reporting date, we are then going to have to mark our futures contract to market. And so we know that as of our first financial reporting date, the fair value is $5,000. So we know we want the ending value of our futures contract account to be $5,000. There was no beginning balance, so that means that we're just going to get to debit $5,000 to our futures contract. Now remember, this contract has been designated as a cash flow hedge. So because of that, it's going to get special accounting treatment, and that special accounting treatment means that this fair value adjustment is not going to impact net income. So our credit here is going to be unrealized holding gain or loss dash, and then remember, the word that comes after this dash is going to be very important because that determines whether this impacts net income or whether it goes over to sit in other comprehensive income as a part of equity until such time as we settle this contract. And that is in fact what we're going to do. So this is going to be equity because it's going to go sit in OCI. So this will not impact net income until we settle this contract. Okay. So then on October 5th, we're going to go ahead and settle the contract. And so what that means, well, first we're going to actually purchase our titanium. All right, so what we're going to do is we're going to go out in the market, we're going to purchase our titanium, then we're going to go back to our futures contract and say, hey, we bought this titanium, market price was $525, you owe us the difference down to our contract price. So when you buy inventory, you're going to go pay cash. They told us the amount of cash out the door is, let's see, so it's 525, so 525 times 200 ounces, and we're going to put that in inventory. Then we're going to go ahead and settle our futures contract. And now notice the price that we purchased it at, 525, is the same as our last fair value adjustment, so we don't need to true that up. That is good. And so we know that we are going to empty out our futures contract account because we're going to cash that in. So we know we want this to be 0. We know that the fair value adjustment before that was accurate. And so we're going to credit $5,000 to zero out that contract. And how that's going to work is they're just going to pay us cash. So basically what happened is we went out and bought titanium at $525. And then our contract, futures contract, says that we only had to buy at 500, so we got reimbursed that $25 per ounce. Okay. Then on December 15th of 2020, Hart sells the clubs that contained the titanium for $250,000, and the cost of the finished goods was $140,000. So the first thing we're going to do is we're just going to record a normal sale. So when you sell something, we're going to assume we got cash on this case, and they told us we got $250,000, and we're going to recognize that $250,000 as sales revenue. Then we also need to get rid of the inventory that we sold. So we're going to decrease inventory. They told us that the fair value, or that the finished goods cost was $140,000. And that $140,000 is going to go to cost of goods sold. However, this cost of goods sold is taking into account the inventory that we purchased at market value, and it is not taking into account this futures contract that we cashed in. So what we're going to do is we are now going to reclassify our unrealized holding gain or loss from that futures contract into cost of goods sold. So we're going to undo this with a debit. So we're taking that out of OCI, and we are reclassifying it as cost of goods sold. And again, this is part of that hedging relationship because we're trying to demonstrate the purpose of this derivatives contract. The purpose of this derivatives contract was to keep our cost of goods sold cost reasonable. And so therefore, we want to make sure the true cost to us of that inventory is reflected on our income statement. So when it comes down here, they ask us to indicate the amounts reported in the income statement related to the futures contract. And so we had $250,000 of revenue. Then we had cost of goods sold of $140,000 minus the $5,000, which gives us a gross profit of $385,000. So we can do the same thing we did before. This is with hedge accounting. If we do without hedge accounting, our revenue stays the same, but our cost of goods sold is higher. So what happens is we don't get credit for this very savvy, I messed up over here. All right, my bad. This is obviously revenue minus cost of goods sold, which gives us gross profit of $115. All right, so over here, we don't get credit for the fact that we were very savvy and we entered into this derivatives contract, which kept our cost of goods sold down from where it would have been had we not done so. And it shows that we were actively managing our profits a little bit better. Now, if we didn't have hedge accounting, we would still have the benefit of our derivative transaction. But remember, it would just be like a gain on derivatives, and it would show up over here somewhere, unassociated with the transaction and the purpose of why we entered into that contract in the first place. One quick last thing before I wrap this up. Whenever a company has a derivative that they are planning to use to hedge risk, if they want to get the special accounting treatments that we've been talking about, they have to make sure that they follow the qualifying hedge criteria. This accounting has been abused in the past, and so the rules are very, very tight on this. At the inception of the derivative transaction, the company needs to document that they are entering into this contract with the intent of using it to hedge a risk. And they must also document what that risk is, and if there is another asset or liability on the books that is related, what it is. The effect of on reported earnings or cash flows also needs to be reported. So the hedge accounting changes the accounting for the derivative or the underlying. And then they must also continually report whether the hedge relationship is highly effective. If at any point the hedging relationship falls out of that highly effective category, that's the point at which they lose hedge accounting. So basically, what they're saying is this whole thing relies upon us identifying a derivative that's going to move in the opposite and equal direction of the hedge item. And so let's say those two things, instead of moving in opposite directions, so one increases in fair value while the other decreases, what if instead they both increase in fair value? If one of them increases a lot slower, they may be able to stay in this effective bucket. But if they continue to go up, that's going to be a problem. So ideally, we want them to be going in opposite and equal directions. There's a couple different ways to do this. There's a hedge, there's the dollar offset method and regression analysis. Both have been used, to document this qualifying hedge criteria. However, that's outside the scope of this class. You just need to know that a Fed hedge does have to be highly effective in order to keep its accounting treatment. All right. So with that, that's going to be a wrap on derivatives. And thank you for joining me.